How do credit ratings impact high-yield bond investments? Imagine you're looking at a list of bonds to invest in for income. Some bonds seem risky, while others look safer. How do you tell which is which? That's where credit ratings come into play. They act like a report card for bond issuers, showing how likely they are to pay back their debt. Agencies like Moody's, Standard & Poor's, and Fitch give these ratings based on the issuer's financial health. Bonds rated below BBB- or Ba3 are called high-yield bonds, often called junk bonds. These bonds pay higher interest rates because they come with more risk. When a bond has a lower credit rating, investors want more reward to compensate for the chance of default. For seniors seeking income, understanding this risk and reward balance is key. If a bond is rated BB+, it usually pays less interest than one rated B or CCC. This reflects the higher risk of the lower-rated bond. Credit ratings also influence bond prices. If a bond drops from investment grade to high yield, its price often falls because many big investors are restricted to safer bonds. This can cause the bond's market value to decrease and make prices more volatile. On the flip side, if a bond gets upgraded back into investment grade, its price can go up. These rating changes can affect the value of your bond holdings, especially if you need to sell early. Credit agencies also give outlooks, like positive, negative, or stable, which hint at future rating changes. Even before a rating drops or rises, these outlooks can influence investor sentiment and bond prices. Staying aware of these signals helps seniors manage their income streams and avoid surprises. Because high-yield bonds are more sensitive to economic shifts, diversifying across different issuers, industries, and regions is smart. This spreads out risk and prevents overexposure to one sector. High-yield bonds tend to have shorter maturities and higher coupons, making them less sensitive to interest rate changes than longer-term bonds. For seniors worried about rising rates eating into their income, high-yield bonds can offer some protection. But economic conditions matter a lot. During good times, high-yield bonds usually perform well as issuers meet their obligations. During downturns, default rates tend to rise, increasing the risk of principal loss. So, keeping an eye on the economy helps you decide when to hold or reduce your high-yield bond investments. For seniors, it's wise to monitor credit ratings and outlooks regularly. This way, you can adjust your holdings if the risk level changes. Using bond funds or exchange-traded funds that focus on high-yield bonds can also help diversify and give you professional management. Just be aware that if a bond fund has to sell bonds due to rating downgrades, it might impact your returns. Balancing high-yield bonds with safer assets like government bonds or certificates of deposit can help you meet income needs while managing risk. To sum up, credit ratings are a vital tool for understanding the risks, potential returns, and market behavior of high-yield bonds. For seniors, knowing how these ratings reflected credit risk and influence bond prices helps in making smarter investment choices that aim for steady income and capital safety.